This last study is really I guess the pinnacle, or kind of puts it all together. And this is a little bit more complex, but we'll kind of step our way through it. This one is we're going to we have a list of mutual funds that we're going to use, and these are stock mutual funds and bond mutual funds. Now we want to we're bringing together, remember, risk management and security selection into this. Since we're going to own we have a list of mutual funds that I'm going to show you in a moment, and the goal is to own, or we always will own, the top 5 funds in the list. So that means that 20% of the portfolio will be invested into a fund at any given time. We used Vanguard funds for this study because number one, they had this style consistency and integrity, and also because they, one of the few fund families that you could find that had data that went back into the late 90s. And so we've again combined bond funds and stock funds into the same list, and we're asking our slow velocity system to tell us if we should be in bonds or be in stocks, and if we should be in stocks, which stock funds should we be invested in. Just like back in study number 1, where we used a mutual fund, where we used money market as our exit strategy, so to speak, of getting out of the stock market. In this case, really the bond funds become the exit strategy to get out of the stock market. We're not trying to rank bond funds and decide in this study, which are the best bond funds to be in, because that's a whole other question and it requires another different approach. But the bond funds, when they start to outperform, they mechanically take your risk down in the portfolio and move money over to into debt and out of equities. Now, these are the funds that we used in our study, and you can see there's nothing magical about these. These are just extremely boring funds. The S&P 500 index, mid-cap, small-cap indexes, you can see, and we've got 2 foreign funds, and then I have 5 bond funds. Remember, in this study, the goal is to own the top 5. So when all 5 bond funds are in the top, you're completely out of the stock market. And again, I'm not trying to differentiate, gee, should I be in long-term bonds or short-term bonds? That may be an issue going forward that we want to consider, but in reality, it's more risky to be in the point, or the supposition, where what we're supposing is it's always more risky to be in stocks than it is to be in bonds, at least for this study. Okay, with that said, and I just want to add one more caveat and say what I learned from this, years ago, numerous years ago, when I came across this, was that, I really didn't need to find the hottest mutual fund manager to invest my money with. What I really needed to find was I was going to get more out of being in the right place in the market at the right time, or at the best time I could be, rather than trying to find the next Peter Lynch. And you'll see that right here. First, again, I want to give you this graphical representation of what that rate of change looks like and how it differentiates and why it works. First off, you'll see in here these lines that run through the center. These are actually the rate of changes of those different bond funds. And I'll also tell you that the limitation of my software here is I can only plot 10 lines. There's 11 funds, so if you're counting the lines by chance, you'll notice there's only 10 of them. It's because I can't plot all 10 of them, or can't plot all 11. So there are 10 here, and they give us a clear representation of what was going on back during this time period. First off, again, let's reorient. Here's the bonds, and then these are the stock funds, and they're either gaining or losing. That in velocity is either increasing or decreasing, and you can see they start breaking down. These stock funds start going below the bond funds back here in September, October, November of 2007. This is actually emerging markets, and it's was the last one to exit the portfolio somewhere in March of 2008. So most of the money was, most of your money was pretty well off to the sidelines. And then again, the portfolio has a couple funds in this rebound in the middle of 2008, tries to get back long again, and then ends up getting back out and, fortunately missing this bigger downdraft. Now this is slow velocity, so the downside of it is, if there is one, if you happen to be an impatient person, it's going to be slow to get out, it's going to be slow to get in, but it's going to allow you to capture the majority of the longer term trends. In a year like 2010 or 2011, where you have these pullbacks that only decline to about 10% or 13% or so, as you get to the bottom of this trough, it's going to finally get you back out.
And the market. Madison, you went off the air for about 2 to 5 seconds. Can you just repeat what you were going over?
Sure. Take me back, Madison. What was the last thing I said?
You started discussing how you were going about the rotation stuff.
Okay. So let's see. We talked about the sell signals and the buy signals, and we also talked about that in years like 2010 and 2011, that when you have these shallower pullbacks, the downside of the slow velocity is that you'll end up exiting your stock, your equity positions or your stock holdings, maybe towards the bottom of the trough, and then the market will move up and you'll get reinvested after it's gone up for a month or two. That's the frustrating when you have these negative performing. You're not negative, but where you underperform is sometimes in these with slow velocity. You'll underperform on years where the declines are not that significant, but it will help you to avoid the larger drawdowns, and that's what we saw in study 1 as well. So here's the actual performance of this rotation, of rotating between these bond funds and stock funds. Here is the S&P 500 again, the annual returns going back to 1999. Here's the drawdown experienced, and then here's the actual tactical portfolio returns of rotating into stocks or bonds again. And again, I've highlighted in green those years which have the higher performance. And you can see that it does a reasonable job in some of these difficult years of keeping you from taking those larger losses. And fortunately, in the years during these years here, there were sectors, subsectors, emerging markets, small caps that were performing better than the U.S. and therefore the portfolio or the slow velocity or matrix pulled that, added those assets to the portfolio and was able to give the portfolio additional returns above and beyond the S&P 500. So I think you can say that it was selecting which areas to be invested in. It was adding those to the portfolio and benefiting the returns. You can see here that the gross rate of return over this period of time for the buy and hold S&P 500 was 2.29% compared to 285%, and the annual rate of return again was 0.19 compared to 11.9. This study that we ran, it has a beta of 0.32 and it has an alpha of 9.6. The arguments against the ones that think that we should just buy and hold a 60-40% portfolio, I put that up here so that you could take a look at that. Of course, it has a gross rate of return of 68.2, which of course was better during this last 10 years than just owning the stock market, as we know. But you can't make I think we can make the argument that having a tactical approach was better than buying and holding this strategic allocation of stocks and bonds. And just for your information, the way that this 60-40 bond portfolio was comprised of 60% the Russell 300 index, the 35% the Barclays Intermediate Aggregate Bond, and 5% T-bills. And those are the returns for that. One thing I didn't cover earlier that I just want to say, in case you're thinking to yourself, why did you choose 200-day moving average or the 50-day rate of change? I just chose them because they're very commonly known numbers in technical analysis. I didn't want to curve fit this this metric to the market. I just wanted to use something that was very broad and general, just so that you could kind of see what advantage this kind of concept can bring. Let's see where I'm. So this is actually the performance graph of making that rotation, owning the top 5. You can see on the chart here we've got the S&P 500 here in red. This green line is the 10% compounded rate of return, and the blue line is the actual portfolio performance. It shows annual returns here, and then the drawdown that was experienced each year is here. You can see the drawdown. Maximum drawdown was about 18.6%, and we can see that our our beta, alpha, what those look like.